Hey everyone, Longacres Finance here, and today I want to show you how you can forecast the future value of your portfolio. I will show you how to do this by forecasting the future value of my quality dividend stock portfolio I've been documenting here on my channel. If you haven't had a chance to see my portfolio updates, you can click the link above. That'll take you to the playlist containing all the updates. Alright, let's talk about forecasting. Although forecasting can be simple, it is also complex because it requires you to make certain assumptions that greatly influence the forecast. You can see my forecast on your screen, and we will break it down step by step. But first, let's go over some variables. This simple forecast requires the following variables. The first variable is the initial value. This is a simple variable to obtain. It's either the current value of your portfolio, or it could be zero if you're planning to start your portfolio in the future. The second variable is the contributions. For this variable, you have to start making some assumptions. Short-term contributions may be easy to estimate, but once you go out far in the future, it gets more difficult. Another thing to consider here are increases to future contributions. Third variable is your timeline. This is another variable that requires an assumption, but is still reasonably simple to estimate. If you're estimating your retirement portfolio, you can use the difference between your current age and the anticipated retirement age. Your timeline will also play a role in estimating the expected market returns, but more on that later. The last variable in our forecast is the market return. This is the most difficult assumption to make. It'll play a pivotal role in the forecast, so it's crucial you make the right choice. Things to consider here are your investment allocation. Are you invested in riskier growth stocks? Is your portfolio more defensive with a large allocation to bonds or treasuries? What is your timeline? Do you have enough years to weather out bad market periods and achieve average market returns? Let me give you a simple example. One of the most popular investing approaches is a 60-40 blend of US stocks and US bonds. The long-term US stock market return is between 8 and 10% per year, depending on the time period you analyze. And the long-term US bond market return is between 4 and 6%, also per year, depending on the time period. If your timeline is 30 years like mine here, it is fair to assume you would achieve a 6 to 8% per year return over that period. Therefore, you can use a 7% return for your forecast, or 6% if you want to be conservative, or 8% if you want to be a little bit more aggressive. Everyone knows that the market doesn't follow a smooth path up, where you can expect to gain 7% each year. Instead, it'll go up 15%, then down 5%, then back up 20%, and so forth. Over a long enough period, these returns average out to the long-term average, and the ending result is equivalent to achieving 7 to 8% per year. Varying contributions will play a big part on your long-term return. If you add considerably more funds into your portfolio before a few bad market years, it'll bring your long-term return down. This is why adopting the dollar cost averaging approach is a great way to catch some of the upside and downside of the market. With dollar cost averaging, you basically contribute fixed amounts periodically into the portfolio, buying as the market goes up and goes down, averaging out your returns over the long term. Before we get too deep into the intricacies of the stock market, let's get back to the forecast and see how all these variables come together and affect the forecast. So here we are looking at a 30-year forecast. I am currently 35 years old and have about 30 years left before retirement, hence was why I'm using a 30-year forecast. The quality dividend stock portfolio is quite small now, at just above $200. I know that probably seems small to some of you, but let's see what value we can expect to get to over the next 30 years. I am starting with an initial value of $300, which is about where I expect the portfolio to finish the year, so we'll start next year with $300. As of right now, I am only contributing $10 per week. That equates to $520 annually. I am expecting the portfolio to outperform the S&P over the long term. The S&P can be used to define the US stock market, since it is one of the most popular equity indices in the United States. If the long-term average return of the US stock market is 8%, I should expect to achieve at least 8%. Our forecast will start here with an 8% return. For now, I am assuming no increase to contributions. Here is our starting market value of $300 and the first year's contributions of $520. The market return is computed as follows. Take the starting value and multiply it by the expected return. Then we're going to add to that the annual contribution multiplied by the expected return and cut that in half. Since that contribution will be going in each week, I can expect that the early contributions to earn the bulk of the market returns for the year, and the contributions near year end probably won't gain much. This works the same way for a down year. Early contributions will incur more losses, while late contributions will incur less losses. To average this out, I'm assuming the contribution will earn half of the expected return during its initial year. The starting value for the following year is the sum of the initial value of the preceding year, plus the contribution, plus the expected market return. And this goes on all the way down for the entire 30-year period. So let's see what I can expect the market value of my portfolio to be after 30 years using the assumptions we just discussed. The market value of the portfolio will be $62,282.36. And that's made up of $15,600 in contributions from me and $48,382.36 of market gains, and the initial portfolio value of $300. Currently, the dividend yield of the portfolio is 1.6%. If this remains unchanged, I can expect around $1,028 and change in annual dividends from this portfolio. The growth is not too shabby, although this may not be enough to retire on. It could be a useful discretionary spending account that could pay for a few decent dinners per year. Let's play around with the variables to see how changing any of them would change our final value. If I was to change the allocation of the portfolio to a higher yielding portfolio, let's say we would get 3.5%, we could expect to get $2,200 per year, so double the initial income. Let's make one tiny change. What if each year I increase the weekly contribution by $1? So in year 1, I contribute $10 each week. In year 2, I contribute $11. Year 3 would be $12, and so forth. Finding an extra dollar each week doesn't seem too difficult. Whoa! The final value almost doubled. Now we would end up with slightly over $120,000. Notice that our contribution more than doubled, but the final value didn't exactly double. If you take a look at the table, you can see the contributions increasing and more funds are added at a later time into the portfolio, leaving less time for that excess money to grow and compound. Let's see what a $2 increase would look like. So with the $2 weekly increase each year, we could expect to have $176,000, getting quite sizable now. So my current plan actually is to increase this by $5, and let's see what that would look like. So increasing the weekly contribution by $5 each year would give us a final value of $345,000, which is a pretty respectable number to have. This might be easy to attain in the early years. Finding an extra $5 per week isn't that hard, but as you can see in the later years here, for example, in year number 19, we would have to contribute $100 per week. That might be a little bit more challenging. If I align the contribution increases with my yearly pay increases, it should be a pretty seamless transition. So with this portfolio value and at the current yield, I would expect to get around $5,500 in annual income. So just slightly less than $500 per month. But let's see if I switched my portfolio to a higher yielding portfolio, say 3.5% again. That would give me just over $12,000 in expected annual dividends, so about $1,000 per month, which is not too bad. Although you have to keep in mind that $1,000 30 years from now is not equivalent to $1,000 today, so this will be a lot less buying power compared to now. Let's assume the market isn't going to return 8% over the next 30 years. Let's say it's going to be worse and give us 7%. See how that affects our forecast. So at a 7% return, we lose about $45,000 and we would finish around $300,000. Let's see what happens if we go the other way. Instead of getting 8%, we would get 9%. That would give us about $50,000 the other way, give us a portfolio value of almost $400,000. Let's go back to our 8% assumption and a 1.6% assumption for yield. Let's say if we went really bold and I tried to increase the contribution by $10 each year. That would give us a portfolio value of $627,000, which sounds pretty good to me. Let's see how much we would have to increase our contribution to get a portfolio value of $1 million. We're going to start with $15 here. And 15 would bring us actually pretty close, but we would need to get a little bit more. 16, I think 17 will do it. Yeah, $17. So if I increased my weekly contribution by $17 each year and achieve an 8% market return over the next 30 years, I should be able to turn this portfolio into $1 million. And that would be made up of $400,000 in contributions for me and $620,000 of gains. And at a 1.6% dividend yield, we would get about $16,000 per year. But if we switch this to 3.5 portfolio, a higher yielding portfolio, that would give us around $35,000 in annual dividends. So there you go. That's how a simple forecast works. You can create one of these yourself. They're actually pretty easy to create and play around with the variables and kind of map out how you want to invest your portfolio and where you can end up. Play around with the variables and see what possible final value you can attain. The one tip I'll give you is the more contributions you put into your portfolio early on, the longer they'll have to grow. So your final value should be higher if you can get a lot of contributions in early. You don't want to put money in that you don't have. The best approach is to invest money that you're not going to need in the short term. It's also smart to automate the process and just have a weekly or a monthly contribution going into your investment portfolio and kind of pick an allocation that you're comfortable with and just leave it and forget about it and let it do its thing over the long term. So let me actually show you another quick thing. Let's say we didn't put any money into this. Let's say our contribution was nothing. So our $300 would end up being $3,000. But let's say we could start with a higher starting value. Let's say we had $10,000 in there right now. So that $10,000, hypothetically, at 8% would grow to $90,000. So it would multiply about 9 times over the next 30 years, which is a pretty good return if you ask me. But let's say you started with $10,000, and let's say you can put $100 per month in. So we would have a $1,200 annual contribution. That would give you $232,000. Let's say you can put $100 per week in. So $5,200 per year. That would give you a $703,000 portfolio. Another thing to note here is you can see a lot of these big gains actually come down later in time. So the longer your timeline, the higher the chances that you're going to build your money up. One of these distant years is going to have a really good return and you're going to make a boatload of money in 1 year or a few years. So start investing early and invest often. That's it. Thanks for watching the video. Please subscribe to my channel for more videos. I hope you learned something here that you can apply in your personal life.